Hey everybody, welcome to our webinar on best practices in M&A due diligence and closing deals in the COVID era. Appreciate you taking the time to join us. You're live from my basement in Westchester County, New York. Not very exotic at all. Really appreciate you all taking time to join us today. We're being joined by an experienced and distinguished group of panelists who have decades of experience, particularly on direct private equity, representing both the buy and sell side and legal space, as well as business intelligence. It's certainly been a challenging and interesting time for all of us in this new reality. You know, we also saw a recent report in PitchBook last week that said deal flow is down 20% compared to this time last year. I think exits are down another 70% compared to this time last year. We've all certainly had to adjust our procedures and processes, certainly when it comes to due diligence. But there's some activity out there. Yesterday, saw the news on PE Hub that Marlin Equity is in the mix to buy big tech subscription service for $900 million. So we hope that this group will bring some clarity into what they're seeing out there, what they're working on, and kind of their outlook for the rest of this year and into 2021. Before we dive into it, just a few logistics for everybody. We're going to reserve about 20 minutes at the end of the discussion for Q&A. You'll see, whether it's on the right-hand or left-hand side of your screen, a question box or a chat box. You could type in a question there at any time, and my colleague will kind of aggregate those, and then we'll go through them with about 20 minutes left. So with that, let me introduce the panelists, and we'll briefly go through their bios. You can read their longer bios on the websites. We'll start with Steve Cooperman. He's a chair and co-managing partner of Morrison and Cohen. He's in their corporate department where his diverse practice focuses on mergers and acquisitions, private equity, venture capital, private investment funds, and emerging company representation. Steve regularly represents PE funds and their portfolio companies in a wide range of transactions, including mergers and acquisitions, leverage buyouts, and preferred equity investments. We also have David Sharp with us, who's chair and co-managing partner of Morrison Cohen. David is one of the country's leading trial and appellate lawyers and serves as a senior counselor to CEOs of multinational companies. He's got over 25 years of experience representing and advising clients in securities, M&A, complex commercial and real estate transactions, corporate restructuring, and other high-stakes business matters. David leads a vibrant litigation and consulting practice that services some of the country's foremost companies, financial institutions, entrepreneurs, and family offices. We also have Nate Ward with us, who's partner and co-founder of Palm Beach Capital. Nate's primary responsibilities include sourcing, structuring, and negotiating investment transactions at the firm. Post-acquisition, he works with portfolio companies on various operational and financial matters, including add-on acquisitions, financing, expansion and growth initiatives, risk management, and strategic direction. And last but not least, comparable, Jay Doughty, President and CEO of Gryphon, my boss. Jay leads a diverse team of over 60 investigative and business intelligence professionals spread throughout the US and overseas. Jay has over 20 years of experience in finance, accounting, investigative work, and has conducted a wide range of financial fraud investigations and have worked extensively on due diligence inquiries and litigation support cases, both domestic and overseas. Jay is a certified fraud examiner and a certified management accountant. So with that, guys, let's dive into it. First question for you is just, what's been the biggest adjustment for all of you guys, both personally and professionally, kind of in this new reality we're working with? Steve, let me start with you.
Sure. I guess professionally, I would say that that David and I assumed the helms of being co-managing partner of the firm on January 1. So in all of the hours that we spent together planning, we didn't have a global pandemic on our list of things that we needed to address. So we were thrown into the fire very quickly. So I think that like anyone who was running a business, very quickly we had to assess what our capabilities were to work from home and make sure that we were set up for that, and then look into cash flow planning so that was an exercise that was thrust upon us very quickly. I would say personally, I think that part has gone smoothly. I've always been a person who has worked effectively from home, and I find I too am in Westchester, so I have about 3 hours of commuting time on an average day. So to pick up those 3 hours has been incredibly beneficial to me, and allows me to get extra work in and also get some exercise in, which I think has been key to maintaining some level of sanity during this period.
Imagine. David, what about yourself? You still like working with Steve in this environment?
Yeah, we're only because we don't see each other that often. But no, the truth is, as Steve said, we went from business planning, business as usual, to crisis management. in a matter of days. So that's a different mentality, and especially for leaders. And it became about making sure that people in our firm felt valued, people in our firm felt that they were part of something, that we were all in this together and that we were going to come out of this together. And while I don't think any of us at the beginning thought that this was going to be going on as long as it has, maintaining crisis management protocols, but developing business as usual in a new normal has been an interesting part of the development cycle. As it relates to things personally, I think I've just found areas that I've tapped into in terms of leadership skills and qualities that I didn't think I had, but it's brought out, I think, as it has in many people, the best in people, and just making sure that everyone is focused, everyone is doing well, is part of what I'll call my personal growth through this process.
And Nate, what about yourself? I mean, I should add that you're in Florida too, so we see these kind of dire numbers. Can you give us kind of the lowdown of what's going on down there?
Yeah, I mean, for us, when this all first started, the first thing, was make sure your family's safe, make sure that your portfolio and your businesses are able to do what they need to do and protect them. When this started, we didn't know how long it was going to last. We didn't know exactly who was going to get impacted from a portfolio standpoint. So we did everything we could to make sure that, we covered all those bases. We communicated heavily with our lenders, and I think that was a big benefit. In hindsight, we've been pretty lucky. We don't have a lot of exposure to some of the worst hit industries. That's some of it is a function of what we don't like to invest in, and some of it's just a little bit of luck. So professionally, I've been working from the office. I've got 4 kids at home that don't respect conference calls and Zoom meetings. So for me, I live, 5 minutes from my office. So, it's just as easy for me to, get out of the house and come into the office. So that hadn't been, a big difference for us. We normally have people come in and out of our office all the time for meetings. And it's just the 10 or 12 of us here now seeing each other day to day. So, I think David said this has gone on a lot longer than we would have thought, but it's bearable.
Jay, what about yourself?
Yeah, there's a lot of different things, but like Steve, I don't miss the commute as much in the New York City area. That can be difficult, and you find yourself with a lot more time for exercise and, sort of getting your day squared away and doing everything you need to do. We were set up to work remote anyway, so it was a pretty smooth transition from a work standpoint. I think the biggest challenge has been, it's a little isolating. I live in New York City, and being in an apartment in New York City can be a little isolating. It's changing a little bit now. People are getting back out, but, not being able to interact with the staff directly, see them every day. I'm actually back in the office today. We started running a skeleton crew in last week, and it's great to see the folks in the office and be able to talk to them and work with them, one-on-one together. So that's probably been the biggest challenge is not having that face-to-face contact, both with clients and with employees. But overall, we're very thankful. We've stayed, relatively busy. Volume's down a little bit, but it's worked well, and our employee base has really risen to the challenge and worked effectively remotely.
Thanks, guys. Maybe starting off, we could share with the group kind of what deals you're engaged in right now. What are the general market trends you've seen at the end of Q2 and now headed into Q3, and kind of what's your outlook for the rest of the year? And Steve, we'll start with you again.
Sure. It's been a little bit of a mixed bag for us. I think that when the pandemic first started, we did have deals in process, and we were lucky in that many of them got completed. Some of them had revaluations. Others closed on the originally agreed upon terms. Once we sort of cleared away that deck of activity, things were pretty quiet. I think that new platform acquisitions, were and still continue to be very rare for reasons that we can talk about. We have seen add-on activity. That's been a big part of what we've been doing. And more recently, we've heard anecdotally from some of our clients that they are starting to see teasers from investment banks that processes are starting to reboot. We've had a couple of deals that have come to life that are new platform deals, but do have roots back in the pre-pandemic period. And I think the key to that was that, in those cases, our clients have had the ability to meet with the management team, which I think is, I continually hear is sort of the biggest barrier for new platform acquisitions is the inability for our private equity clients to really sit down and get to know the management team and study the management styles, the company culture. So, in the deals that we're doing now, that barrier doesn't exist. But again, I think we are hearing anecdotally that, some processes are starting up, and, it's yet to be seen how those will play out. I think that, the recent spike in prevalence of cases really across the country, could damper that enthusiasm.
David, similar things you're seeing as well?
So obviously we're in the same firm, so we see different things. We see similar things, but one of the areas that I live in is the distressed world. And in the distressed world, I think in let's call it by the first week in April, everyone was saying things are going to get really bad. Let's just start looking for where the opportunities are. Obviously, the Fed did a lot to inject liquidity into the marketplace, which put a pause on the way people were approaching, or the precipitous expression of the distress and a loss of value wasn't as stark as it was expected. And some of those conversations are still going on. We're having the same conversations now in the beginning of July that we were having in the beginning of April, because when's it coming? Is it coming soon? And getting ready for that, deploy the capital, find the areas beyond the areas that I think people are thinking about are going to be so impaired for such a long time that that's not the opportunity they're looking for. And I'm referring to particular hospitality and retail. I think people are looking at that as long-term impairment, but where people are looking for value in terms of the investment and distress, they're looking for investments where people are liquidity constrained, have desperation, can make quick, good deals, and then can pick up in 2021 to start returning money and investment opportunity to their clients.
Nate, what about yourself?
Yeah, I mean, I think Steve and David hit most of it on the head. We've closed 3 add-on acquisitions since April. They're not new platforms. They've been to grow existing platforms. We knew the managements ahead of time. We have, bank financing already in place, and they were really additive to what we were already doing. So those are a lot easier to do. We've got 2 more that we think will close before September 30th. So that's where we spent most of our time. The existing lenders have been great. That's, I think, one big difference between now and 2008, 2009. 2008, 2009, they got very aggressive, and that added a whole new dynamic to what was already problematic for business management teams. This go around, they've not at all. They've been very friendly, very communicative. And so the challenges we're having on new platforms is, as David and Steve mentioned, you don't get that face-to-face management time, which is really important to know who's going to be your partner for years to come. It's not just all numbers and industry. It's also the human element. I think the positive and the negative effects of the coronavirus are making the buyer and seller skeptical of numbers. Are numbers inflated because of it? Are they, the sellers, trying to get credit for deflation of their numbers? I think that makes the bid and the ask spread a little wider. And I think there's going to be for in the short run, I think we're going to have some challenges closing that bid and the ask. And then lastly, I think bank lenders, while very supportive of existing portfolios right now, I don't think they're going to be as aggressive on new platforms, and that's going to hold down purchase prices, and that'll keep that bid and the ask, somewhat far apart.
Jay, what about yourself? I know Nate was talking about add-ons. We're seeing, similar trends, particularly with some of our private equity clients. Wondering if you could go into that a little bit more.
Yeah, no, that's right. I mean, overall deal volume's been down, obviously, but where we see most of the activity is in add-on acquisitions for the reasons that Nate described. So, in a lot of cases, these are clients that we worked with on their initial investment, and now either the private equity firm or the portfolio company is coming to us directly to look at add-on acquisitions. So that's drove a fair amount of activity in the PE market. Nate and I were talking a little before the call. We've seen some more VC activity, maybe than we've seen in the past, and we're seeing it in certain sectors. Technology, healthcare. We did some diligence around Instacart. It was raising additional funds, and we did a recent deal involving a technology platform. It's an app-based training technology. So for obvious reasons, certain areas are popular during this pandemic, food service delivery, technology. And then in the PE market, mostly around healthcare is where we've been doing a lot of diligence, some skilled nursing facility roll-ups and some physician practice group roll-ups. So, overall, it's been good. Overall volume's down, but certain industries are popping, and for whatever, I'm not sure what the reason is, but a lot of deals are on a short time frame now. I don't know if that's because there's more people looking at fewer deals, but the cycles are really escalated in terms of the investigative diligence that we do. So those are a few of the things that we're seeing.
Thanks, Jay. I'd like to shift gears just a little bit, talk about due diligence. During this pandemic, what areas of diligence have you guys seen that have become more significant? How are you adjusting your processes? Steve, I think I'll start with you on this one. We were talking the other day, and you had mentioned that era of going to a company and sitting in their office, meeting the management team, or going to tour a plant, or whatever facility, are long gone. How do people adjust to really do a deep dive and understand what's going on, beneath the hood?
Yeah, I think that, at least from a legal due diligence standpoint, the notion of actually doing on-site due diligence has been, really a relic of the past, even, pre-COVID. It's, with the advent of data rooms, everything was really done virtually anyway. So there hasn't been a big impact on that. And, from the business side, and, Nate might be able to touch on this too, what I've heard anecdotally, I mean, we haven't heard any of our clients that have done it, but, to address, the due diligence around the physical plant, people are using GoPro technology or having someone walk around with an iPad and, conduct a virtual tour. I've even heard of using drones, but, again, that's sort of anecdotally. I haven't seen that in practice. So just switching back to the legal side, I think it's less about the how and more about, as you said, the what. I think that, in addition to the normal areas of due diligence that one would conduct for any acquisition, I think that COVID has highlighted a number of areas of increased importance, from OSHA compliance, employee health and safety, compliance with regulations that were implemented in connection with COVID-19, quarantine restrictions, stay-at-home orders, assessment of material contracts, force majeure provisions, assessment of customer and supplier relationships and supply chain issues. Those are the sort of things that have come into focus. One other area, obviously, is whether, any company has availed itself of any of the provisions of the CARES Act. So people are looking at, whether you took a PPP loan and whether you complied and kept the right records. I mean, ultimately, it's treated as debt anyway. So whether it's forgiven or not is going to fall on the seller. But those are the types of things that, that people need to look at. Cybersecurity is obviously, of increased importance with everyone working from home, and, and the increased number of, ransomware attacks. Those are the types of things that, that you really need to pay careful attention to now.
Thanks, Steve. David?
Yeah, so to pick up on a couple of Steve's themes, first of all, physical inventory is an issue. And while many companies have physical inventory count being done in an automated fashion, when you're dealing with businesses that have been generational family businesses that may not have made that type of investment, COVID-19 has created an impediment to getting physical inventory done. And I think one of the interesting outcomes of this, right, is what is the acceleration process going to be in the marketplace as a result of COVID-19? And that is, I think, companies are going to accelerate into technology the way so many of our businesses have accelerated by virtue of what's happened. So what may not have been as commonplace in terms of inventory count systems being automated and electronic, I think that's something that we're going to see a rush to have that happen, because you can't have a pandemic basically create an absolute blanket over what your most important product is. As it relates to some of the legal due diligence issues, Steve touched upon the force majeure provisions, but when you're dealing with contracts that are out there for 10, 15 years, there were so many provisions that people always thought of as simple boilerplate, and lawyers were told, don't negotiate the force majeure provision, don't worry about casualty. But the one thing that we have been looking at during this period of time have been the MAC provisions, material adverse events. How is casualty defined? Do you have, what are your insurance? Do you have pandemic insurance? Because so many people assume business interruption meant that you had pandemic coverage if there was a governmental order. I mean, you think back, the last time governmental orders shut down businesses were in World War II. And the evolution of the boilerplate that goes into contracts has changed over the years because it became not relevant. So things started to drop out. The relevancy of these provisions in the due diligence process can affect valuation as people are more conscious about, are there governmental shutdowns in our future? And if so, how is that going to affect businesses? Now, one of the other issues that Steve touched on that I want to draw forward that we've seen is, the PPP loans, are they permitted debt under senior loan documents? And does that create an event of default? And are those defaults being waived? Are there been consents to those, or have those? And there's been some litigation on those issues. So those become issues that in the diligence process, when you're looking at a company, you're looking at the value, you're looking at the value of its contracts and the predictability that one needs to be able to say, what's the sustainable cash flow? What are the assets and liabilities? Understanding and taking a deeper dive, our mindset has shifted. The things that we're looking for is a lot broader than it was 6 months ago.
And Nate, what about yourself, particularly when you're talking about, you're focusing on add-ons? How are you going about conducting your due diligence, during this time period?
Yeah, I mean, really, there's really been not much of a change on how we're doing it, except there's less on site. On the add-ons, we can still kind of pull that off because we know the competitors. Our management team knows the competition. Quite candidly, we've actually still been traveling to the add-on locations where it was possible. We still use the same processes. Our attorneys have not really been affected by this. They've been successfully working from home. Jay, I'll give you a shameless plug. Gryphon Strategies is, they're set up to do their due diligence and background checks. They haven't missed a beat at all. So really, it just comes down to the face-to-face meetings. I mean, the data rooms, no impact. Analyzing the companies, no impact. But it's really comes down to the face-to-face meetings. Makes it tough to do a new platform. I'll give an example. I was slated to go to Chicago on Thursday and Friday of this week to go see a company that's manufacturing business that is acquiring a competitor. It'd be a new platform. I've never met this owner face to face. I've had numerous calls. They don't allow Floridians to fly to Illinois without quarantining. I'm not going to be able to buy this company without spending face-to-face time with that owner. So for me, there is a limit to what we can work around. We do need face-to-face time. And then just one other point on the PPP loans, that's a really sensitive subject for a private equity firm. We know that there's tons and tons of scrutiny. private equity firms. And so when some of the deals we've bought, they received PPP funds prior to us making the investment. And we've escrowed 100% of the PPP funds. We don't want to get entangled. We waited to close until they had filed all their documentation, because like in a stock deal, we don't want to file that information for them. We don't want to get sideways with our seller, and we also don't want to get entangled into the federal government process. So that's how we've handled that. We've had no pushback from the business owners in handling it that way. It doesn't change their process. They just have to escrow those funds. So that's kind of how we've gotten around that.
Sure. And Jay, can you talk to us about the importance of due diligence in this market, not just seeing what's out there in the public record when there's a transaction on the table, but going beyond that and the importance of gathering human intelligence?
Yeah, absolutely. We're focused really on the investigative diligence, so in-depth background checks on the management teams of the companies that PE firms are looking to buy or VC firms are looking to invest in. We don't really do work on the legal or financial diligence side, but really that investigative diligence. And the way we do it hasn't changed a whole lot. We're looking at in-depth public records. Obviously, some of those have been slowed down a bit by court closures, and things like education and employment verifications are a little more difficult to get just because people are out of the office and it takes a little bit longer. So we create a lot of pending items like that. But we think investigative diligence in particular is even more important in this environment. As Nate indicated, you can't really go meet with management teams face to face. So knowing about their background and really looking into the details and understanding who you're dealing with and whether there are issues out there is something you can do through the investigative diligence process. And it's not going to replace sitting down with someone face to face, but the more background information and intelligence you have about those people, the better off you're going to be. And you mentioned, human intelligence, Matt. Again, we do a lot of that work pre-investment. So not only the public record side, but we go out and identify people that have worked with the subjects over a period of years or had relationships, in a business capacity, and we conduct interviews and gather intelligence there, about, their track record, any problems in their background, as well as their ability to execute on game plans, their management styles and abilities. So that sourcing information gives you so much more, of a rounded view of the person than just what you see in the public record. So we think that's very important, and we're doing a lot of that now and pre-pandemic as well. And then one final point, we've also created some what we call monitoring projects around existing investments. So a lot of our clients are looking inward right now. Maybe they're not doing new acquisitions. They're looking at existing portfolio companies and how they're performing. So we've set up some tools to be able to monitor what's going on with companies and executives, on a very frequent basis, daily, weekly, monthly, quarterly in some cases. Just, so if something does come up, there's some problematic litigation, there's a significant personal problem, some sort of a financial issue, the investor knows about that sooner than they may have otherwise, or if it's not disclosed by the management team. So we just feel like that gives an added value of intelligence, about the portfolio companies, as well as the pre-deal diligence.
Thanks, Jay. And before I move on, just a reminder to those listening in, if you'd like to ask a question, just type it in the questions box or the chat box. We'll leave those till the end. I don't want to be the only one talking, asking questions here. So, but Jay, staying on that theme here, we've seen a lot of requests for some of our PE clients are making changes at the C-suite level to their existing portfolio companies as people are looking inward, as you said. I'll direct this more towards Nate. Is this crisis revealing some weaknesses within portfolio companies, and have you seen a trend where people are replacing C-suite executive to breathe some new life into it or bring a new strategy, or is this not the time to kind of replace the horse in the middle of the race?
Yeah, I mean, our first instinct is to reduce risk on our investments, and so in a time like this, unless it's a glaring issue, we would not tend to make a drastic change at a company. We may make plans to do so based on something we saw during this period, but for the most part, we're not going to try to elevate risk going into something like this. We want to control risk and we want to minimize it. But it does, sometimes this does expose work habits. It exposes, positioning on, the companies that are doing the best during this are technology enabled businesses, businesses that, that haven't kept up with that and haven't kept up with, a web interface or a web communication system. They're getting exposed right now. So, in short, I would say we're not looking to elevate risk, but it does make you reassess, some of your team and what you might need to add going forward.
Great. David and Steve, anything on that end?
Now, Steve, I don't know how you feel about it, but I think to double down on what Nate is saying, I think we've seen less executive comp movement just by virtue of the activity that we would typically see in a second and third quarter from our practice. I mean, we have a national and international recognized executive comp practice that is, across so many industries and especially in financial services and a lot of movement that we might typically see. We haven't seen that, I don't think, and I think that's indicative of the fact that people are assessing, keeping the fort together, and I do think that these crises, a crisis will always uncover problems, and the question will be, is it only crisis management that was problematic, or are there more significant underlying issues that require change? And I think as we come out of this, we'll see an uptick in activity.
Sure.
I would agree with you.
Yeah, I mean, David, you were talking beforehand about, this issue of liquidity, and especially in distress-driven industries, companies are desperate for cash, particularly across like hospitality, entertainment, retail. Is that where a lot of the opportunities are going to present itself? Kind of a two-part question, for Nate as well. Are you seeing distress-driven opportunities on your end? And then how do you go about evaluating these companies?
So, I would start out by saying, I think the opportunities are going to be when there are good assets and good businesses that are not necessarily liquidity constrained by themselves, but perhaps their owners have external pressure to create liquidity because they're invested in other businesses or they have other things going on that have created an external crunch on their need to create cash. And when that starts to happen, good businesses and good assets become available. And I don't know if Nate would agree, but I'm going to jump in and say that I think that's probably where the best opportunities will be, because when you look at retail and you look at hospitality, you're looking at a much longer recovery trajectory.
Yeah, I agree. I mean, I started off by saying, we got a little lucky, and then we kind of determined some of our luck. We've always avoided oil and gas. We've always avoided retail. We've always avoided hospitality, and some of it's just because we don't understand it, and some of it is just the cyclical nature of it. That has served us really well during this pandemic, and so I think the investable areas, unless you're a real graveyard bone picker, the investable areas are what David just said. They're good businesses that, maybe it was making, 20 million of EBITDA, and now it's making, 15, but the leverage is, the leverage ratio has gone up because of that. It's still a good business, and it likely will still recover, but there could be a need for capital. And so we do a couple things at Palm Beach Capital. We do minority and majority investments. I think there's going to be a lot of good minority investments, which most people don't do, in high quality businesses that don't want to sell, but they want to shore up and ensure the safety of their business and their families' wealth. I think we're going to see a lot of that, and then people want a good partner. So we hope we can bring both of those to the table. For these groups, the lenders have been very eager to help, and so I have not seen a lot of deals where I've seen some, but they're mostly in the industries where David mentioned, where there's real trouble long term, and those are just pretty scary to invest into right now. At least especially given that we're sitting on 15,000 positive tests a day here in Florida. It's a little scary right now to invest in something and think that you found the bottom. I think the better opportunity is the high quality businesses that maybe their balance sheet's just a little out of whack, that you can see clearly that you can correct that and they'll come out of that. So that's really what we're looking for, and I think there's gonna be a lot of those opportunities in the next 6 months.
And I think as you talk about finding the right valuation, I think as we get a little more into this, it'll be easier to start creating a model of what normalized numbers are. I think, March, April, very difficult to understand how you normalize the numbers that you're looking at. But between business people and the legal and the investigative, I think we all can come together and start recognizing, what was 2019 like, what was 2018 like, what are we looking at in this environment, how long do we think the trajectory of this environment is, and we can start modeling that out and start normalizing things to create, because normalization of EBITDA numbers is something that happens very often in transactions. It's based upon experience, it's based upon know-how. And I think as we learn more about where this is going and where the businesses can go and how they're performing in these early stages, we'll be more educated to be able to come up with better valuation numbers.
Steve, anything to add?
I would agree with what David said. I think also, just to touch on what Nate said in terms of what his shop is doing, I do think that you're going to see a lot of the financing come in the form of growth equity. And I think with that, I do think that there is going to be, a leverage tilt towards the investor in this case. I think you may see more aggressive terms in terms of, participating preferreds where you get your money back and then you participate on on an as converted basis. Whereas I think the market, more recently, pre-pandemic was more basically you just had downside protection, but it was basically, a common type investment, with just some hurdle protection. So I do think that you will see shops that may have typically restricted themselves to control and traditional buyout, expanding their investment mandate to take advantage of, of the market that's there.
Sure. Jay, anything to add on that we've seen from our clients?
Well, probably nothing I've already covered that I haven't. Just the importance of, again, the sort of knowing who you're dealing with. You're taking on additional risk in transactions in this environment. And, we feel like the investigative diligence process, the source intelligence, all of that can help mitigate some risk in this environment.
Sure. And Nate, let me shift a little bit here. And just a reminder for people, we're about the 20-minute mark. So please, don't hold back if you have any questions. Nate, can you talk to us about fundraising in this environment? I know you guys just closed a growth fund, but just, what people are saying out there, has it been challenging?
Yeah, you stole my word. In a word, challenging. The same issue we have on new platforms. Any new investor, institutional investor that is looking at Palm Beach Capital, they want to come on site. Most cases, they want you to come on site. It's a dance. It takes time, and it's not a one and done type meeting, for $20-40 million check. So it's been challenging. The timelines are stretched out. We actually are fundraising right now. We had a first close in January, a second close in March, and I would have thought we would have been done by June, just based on verbal commitments from existing investors. And even our existing investors that have already given us their number, they've got a hold on a spot for them. A lot of them they're not even able internally to commit until August, September. Some of that's driven on let's just wait and see where the economy goes. And some of that is just functionally, if they can't go on site, they're prohibited from making an investment. So it's just going to stretch out time horizons. There's plenty of capital already closed on in the market. So I don't view that as any kind of a creation of a shortage of capital. There's a huge overhang of private equity funding, especially at the high end of the larger end of the market. So it's just going to take patience, and it's just going to take more time.
Yeah. And Jay, what are you hearing on your end from our clients that you talk to?
Yeah, it's a little It's a little frustrating. It's been sort of a volatile environment. So, the end of March, things dropped off considerably. We saw kind of a steady state in a few months following that. Early July has been off to a really fast start for us. Now that could be, again, just one of those spurts of activity. The difficulty is not really knowing, when things start to really turn and pick up. I mean, I think we all feel like and know that's going to happen. Just the timing of it is a little difficult to predict. But it feels like, there's more transactions out there now. There's a little more activity. Obviously, the wave of cases around the country is a little concerning, and how that affects the markets. But, it feels like it's starting to pick up. I'd be curious what the other guys would predict in terms of, future activity.
Steve, you want to prognosticate first?
Yeah.
Yeah, if I had that ability, then I wouldn't be sitting here as a lawyer. I would be putting my talents to some other use. But look, Jay, I think, and David touched on this earlier. I think what we've heard from our clients is, apart from the management meetings, they really feel they need to see 1 to 2 to 3 months of sort of post-COVID results, whatever you define that to be, in a business before they could get to a point where they feel that they could make an intelligent assessment of what they think normalized EBITDA is. So I think that, when we're in a situation where, there are so many states that you can't travel to without having to deal with quarantines, on the front or back end, it precludes the management meetings. I think it's, you have states that are pulling back on opening up. It precludes businesses getting back to normal, people getting back, to the workplace. It's really hard to know. I think if you would have asked me in March, I would have thought that you would have, started to see things pick up in Q3 and Q4 to be really booming, with all of, the deals that had been put on hold. But I think that, that might have been 1 to 2 quarters optimistic, and, and we might be sitting here 3 or 6 months from now, I hope not, saying, that my prognostication today was too optimistic. It's so hard to know.
From a fundraising perspective, we had clients that were about to go out into the market and do roadshows and do them in the Middle East, in Europe, in Asia, and that never happened, right? They never made it there. And so some of the fundraising aspects that you would typically have in going out and seeing your clients and prospective clients and meeting with agents in foreign countries that have a lot of foreign capital that were looking to invest here in the United States, those things haven't happened. It has resulted in our clients relying on local assets and relationships that they have to do their job for them. And I think for people who are out there fundraising, and that's part of their control, and it's hard to do. It's hard for the investor. It's hard for the people that are raising money when they're dealing with an intermediary. We have a bunch of clients and relationships that are, let's call it, onto Fund 5, 6, and 7, and those that have the steady track record of investors 20, 30 years, and they're raising a credit fund, they're raising a distressed fund, they're raising an opportunity fund. They are getting the committed capital from their investor base, but like Nate said, those are sort of the really large ones in the marketplace. The middle market private equity funds, again, they're depending if they're on Fund 2 or Fund 6, the fundraising aspects of it, could be a little more difficult, could be a little more challenged. But people do want to take advantage as investors, right? They're looking for the opportunity, and they're looking for qualified people to deploy their capital. And if those connections are able to be made, it may provide entry for investors into funds with managers and firms that they may not have otherwise been able to get access to because others have not been able to pull the trigger.
Nate, I'm curious to get your thoughts on, as I mentioned in the beginning, I think exits are down like 70%. Have you had to adjust your timeline in terms of companies you're looking to sell? Are you just trying to drive more value out of existing portfolio companies that may be a little underperforming in this market?
Yeah, I mean, private equity is set up well for that. I mean, we buy companies. It's in a liquid market. When we buy them, it's a liquid when we sell them. So we never plan on exits. Anything can derail an exit. A bad quarter. That's part of why we generate higher yields, is because we can pick and choose our exit timing a little better than a public market mark to mark delivers for you. So yes, we've had a couple companies that we would have expected to sell this year that, one of them still may. I mean, they're both performing actually really, really well, but the market, for transactions closing is declined for sure. And, the businesses are performing, so there's no gun to our head to sell it. And so, we continue to get good returns out of them, and we'll just wait until the market comes back at pricing that we like. I mean, a couple points, interest rates are even lower than they were, going into this. So that's helpful for exits. Banks are very healthy from a capital standpoint. That's helpful for exits. They're kind of starved for earnings at banks. And so private equity style and transactional style deals are more attractive to them than maybe they would have been as they get better spreads. So I think all of that is favorable. It's just the uncertainty that's not. And eventually this little cloud will clear. I, like Steve, I actually thought, by August, September of this year, most of this would be behind us. I didn't expect it to kind of ramp up again during the summer. And obviously I was wrong with that. But, I think you'll see this stuff come back, but you just have to prepare for, several more quarters of, uncertainty.
Sure, absolutely. David and Steve, similar experience on your end?
Yeah, yes, let's go ahead, Steve.
I think Nate makes a very good point that I think that, all of the fundamentals are there for a quick return to deal activity when the overhang clears. I think it's very different in that respect from 2008, where the issues were much more systemic.
One other point, in 2008, we were getting investors, we're on our fifth fund now. We were getting investors calling us, asking us about when we were going to have liquidity events. They were short of liquidity on their end, and they were calling us to get clarity on our end. We haven't had any of that this go around. The liquidity situation is night and day. The stock market rebounded kind of inexplicably. I think surprised everybody. So there wasn't this denominator effect of I'm overweighted in private equity. My liquid securities went down. So I just think this is a lot different this time, and I think people just seem to be much more patient than they were.
I think what Nate is referring to in terms of what we saw was the rush to redemptions. I don't think we're seeing that at all.
Yeah. I mean, and Jay, maybe you could talk a little bit about the importance of the due diligence process as well. When there's an exit, maybe one of our clients is looking to buy a previously owned, PE-backed company. We hear a lot of times, well, the diligence had been done already. Don't need to worry about that.
Yeah, listen, I mean, you always want to consider the risk in any transaction and, do in-depth investigative diligence. And, in this market, depending on the industry, things that may not have been important in the past may be a little more important now. For example, we recently worked on a big nursing home roll-up case, and things like fines for cleanliness or OSHA violations. I think Steve mentioned some of this activity. That in the past may not have raised too many eyebrows. In the environment we're operating in right now, and with the pandemic and exposure to COVID and nursing homes and things like that, that might be a really big issue for investors. So we try to keep that in mind when we're doing our diligence. Obviously, try to highlight those key issues and key risk items, and consider the environment that we're operating in right now, and be able to point those things out. So I would say that's something to pay attention to, is the specific risk factors in light of the market conditions and what's going on.
Sure. So we have about 10 minutes left. Just a reminder to ask some questions. Don't hold back. If not, David's going to hijack the event, and we're going to be here for another hour. But,
oh, wow. We're getting into my reputation for taking up a lot of airtime. Great.
You've been very well behaved this time. But maybe
Okay.
David,
Thank you.
while I have you here, you were talking about loan provisions before in some of these contracts. You know, they're originally supposed to be in place for like 10 or 15 years, but I think the other day we were talking about that this may not be the last pandemic we see in 10 or 15 years. You know, how is flexibility going to be built into some of these contracts moving forward?
So, Matt, what I think we're talking about, and we're seeing this, we represent a lot of, let's call it hospitality and entertainment companies, theater companies that have our national chain, casinos, adventure places, ski resorts, things like that, and they have, in terms of the way they are structured, of their debt load, in terms of there are 10 to 15-year deals that are out there in terms of their financing, but all of those operating businesses have covenants that are predicated on cash flow, right? Because every single one of those is fannies in the seats, people that are coming into the resorts, who are pulling on the lever in the casino, who are placing bets, who are taking hotel rooms, who are getting on chairlifts, and the world has changed with respect to all of that. And I think this goes to what Nate was talking about in terms of the environmental factors of how lenders are predominantly looking at this. They're not blaming it because, as Steve said, in 2007 through 2011, it was viewed as a systemic problem. The lenders were very, very aggressive. They don't want to take, the lenders don't want to take back these assets at this point in time. So it becomes about, what does the forbearance look like as it relates to cash flow, to debt yield, to people going through turnstiles. We're seeing this play out in a very national stage as it relates to sports coming back. What's driving the NHL, right, to come back in August through October? What's driving the NBA? That's because there are other revenue models that are forcing them, other than people in the actual stadiums and arenas, to come back. But the other businesses that don't have sports sponsorship deals that are, or television contracts that are saying we need to get out there, they have to work with the lenders, and the lenders are confronted with the choice: are we just simply going to waive these provisions or defer them, allow the businesses the air to breathe to come back, or are we simply going to take them back? Because the borrowers, there's nothing they can do about this, right? There is no way that if they went to Miramax and said, I'll pay you anything for your best first release film, that they're going to be able to sell popcorn. It's not happening. We can't get people back in the casinos. We can't get them in these artificial ski resorts that operate 24 hours, 365 days a year. All the quality entertainment that surrounded real estate acquisition, which became a primary driver for where you were going to be, the amenities that drove development, that drove communities, that drove commercial development, that drove hospitality, that entire environmental factor has been disrupted. And that what that really means is the operating businesses that are there are either going to be given room to breathe and come back, or the cap stack is going to be completely reorganized by virtue of the lenders taking back the assets, working with new operators, or giving the existing operators a hope note at the back end. But right now, in terms of looking at it, the lenders aren't looking to take back the assets. Because I think in some ways, if they did, they'd be actually so overwhelmed that we're not dealing with bad actors. We're not dealing with bad operators. Now, they may be out there on the fringes, but the big struggles are with people who are not bad actors, who aren't bad managers. They've just been affected by the pandemic.
David, the only thing I would challenge you on that, I agree with everything you said. If this pushes into Q1, Q2. I don't think it will, but if it does, the lenders will be patient for only so long. And everyone answers to someone, and they'll be answering to someone, and at some point their patience will run out. But I don't think we're gonna see a lot of that, but I think we will see some of it, especially areas like the oil and gas industry. I mean, how much longer are they going to be patient at $35 oil that these leverage companies? I mean, I think you're going to see some bad stories.
Oh, Nate, I agree with you completely. I mean, the forbearance
your restructuring practice is going to have its day.
We're busy already because these forbearances that are being entered into, whether they're 6 months, 12 months, the farthest ones that we're out there right now are 18 months, and they're in the hospitality industry, but they are not that frequent. I mean, they're being negotiated because there are reasons for them being that far out. And they are lender-borrower centric, but those negotiations are ongoing, and I agree with you. I think the level of patience will start coming to an end in Q1 unless things are really turning around.
And if I could just jump in here, guys, we do have a couple audience questions, only a couple minutes here. This is for Nate, and then also like to bring in Steve and David as well. Are you, Nate, are you reworking management annual incentive plans for your portfolio companies as a result of COVID?
We really haven't had to, knock on wood. We've got about 15 platform portfolio companies. We've had, 2 that I would say, one has really been impacted. It gets a lot of business in Orlando from Disney and places like that. The other is a last mile logistics business, but it's ramping back up very quickly. We really haven't had to do that. I think when the full pressures and damage from all this is done, maybe in a couple instances we'll have to relook at that. But for the most part, we've had a lot of businesses that I would say are maybe down 5% to up 20%. I mean, we haven't had a lot of problems, thankfully. We had a lot more in 08, 09. We had a lot more of that.
Yeah. David and Steve, real quick, are you guys seeing clients rework?
The person in the box over there.
annual incentive plans?
No, not really. I mean, I think that it'll be interesting as firms come out with their second quarter marks and you see really where, people are valuing their portfolios, how management may react. But our private equity clients, I think, have had similar experiences to Nate. They're not doing it, nor do I think that there's been any real demand or outcry from the management teams for that exercise. I think the management teams are focused on, whatever they need to do for the business. And I think they probably share in the sentiment that, that the issues that are confronting the particular business, can be navigated. Some of them may be a little bit more existential, and, you may ultimately have to revisit whether you've adequately incented your management team, but that hasn't happened, from our perspective yet.
Mm-hmm. Good. Well, I think with that, guys, we're out of time. I just want to thank you all for taking the time to join us and, share your thoughts and experience in this challenging environment. And thank you to everyone who joined us. We really appreciate you all taking time out of your day. We'll send some follow-up notes and connect everybody via email, and hopefully you guys will keep the conversation going. So enjoy the rest of your day and have a great rest of the week. And thank you all so much.
Yeah.
Take care.
Thank you,
everybody, guys.
Appreciate your time.